Hello, everybody. My name is Jeff Smith, and thank you for joining today's webinar from Veloce Capital. We're going to be talking about today's real estate investment options. So I just want to run over a few things before we get started. One of it is I'm going to be your host, Jeff Smith. I'm going to be asking Surf Danani and Ryan Yates a bunch of different questions, and we'll be discussing various facets of today's real estate investment market. And I got a few points here. So for all those who are registered attendees, you will receive a recorded version of the webinar. This will be sent to your email. So if you haven't registered, please do so, and then we'll just send it right along. Thanks very much. For questions, if you have questions, please ask. There is a question dialog box in this interface. See a chat bot. So if you would please just put your questions in there and we'll answer it once we get to that segment. So today's webinar will be collaborative. I will ask as the host and we'll have the panelists respond. And so it's a very simple agenda. We'll have a quick introduction of Veloce Capital and then move right into three main topics. So the topics are, what do investors seek in passive real estate, multifamily investing? So that's a discussion of investors' interest in passive multifamily real estate and considerations for investing in today's marketplace. Topic two is Veloce Capital's position and the niche on delivering more ways to invest in this understanding of passive real estate. So it will provide an understanding of the company's investment portfolio, some of the performance understandings and investor ROI. And then we'll wrap with topic three, which is an update on, today's market, so what's going on today and what options are available to investors. All right, so let's jump in. We're going to bring in Surf and Ryan Yates. So if we get those guys in, that's great. Hello, everyone. How you guys doing?
Hey, guys. How are you?
Awesome. Cool. So let's start it off. All right. So enough of me, more about you guys. So we have, to my to my right, visually, is Surf Danani, CEO of Veloce Capital, and below me is Ryan Yates, Vice President of Compliance. We're going to start off real quick with just an understanding of who Veloce Capital is and, what aspects of Veloce Capital's investment structures align to this world of passive multifamily real estate. So, Surf, you would start us off.
Sure. So thank you all for joining, and wanted to introduce myself for those of you who don't know me. Surf Danani, CEO of Veloce Capital. Veloce Capital is a real estate investment firm, right? We focus in debt and equity strategies through various structures in providing capital to real estate developers and other investors investing in real estate, where we can somehow structure a transaction by either being some part of the capital stack. Our main focus is, to receive passive income for our investors, providing them with, stable opportunities and consistent returns. That's our goal in Veloce Capital. And through this, we have, various different structures that I'm sure we're going to get into today and different opportunities available. But the main focus is always finding good markets to invest in with great upside for our investors and our firm.
Oh, that's awesome. Thank you very much. So we're going to jump into our first topic. So the topic asks, what do investors seek in passive real estate in multifamily investing? Right. So it's a big question. It's open-ended question. So it's looking at what are the considerations that investors have in today's marketplace, right? And then what's available for accredited and non-accredited investors. So, Surf, why don't you start us off again, and then we'll jump to Ryan.
Sure. So, in today's market, investors have, a slew of options where they want to invest their capital, right? So traditionally, we've always seen, and, we've been taught, hey, invest in stocks, invest in bonds, invest in real estate as well. Now, in each one of these categories and other investment vehicles that are there and other investment options, there's certain, you can't just say invest in real estate. What does that mean, right? So what we've done here is, given another option for investors outside of the traditional norms of investing. So we handle, everything on that side of investing in real estate, right? The managing of the asset, the managing of the development with the developer, managing the cash flow and the distributions or the interest payments in one of our funds, or the dividend payments in the other, to our investors. So it's really a passive investment option for investors. And within that passive investment option for investors, we have different ways of investing as well, right? We have different, we have 4 different funds, and then we also have standalone deals. So, what investors seek in passive multifamily real estate investments is, stability, of course. So stability of the asset, appreciation of the asset. So we're looking at anywhere that we invest, anything where we're putting investors' capital into, we want to see that there is some sort of appreciation that's better than, a normal traditional investment that the investor might be doing. And then the third part of it is steady and consistent cash flow. So that's another thing we look for at Veloce Capital. We want to make sure that we can have steady income, and it's also double-digit returns for the most part, where it exceeds what investors are seeing in traditional investments.
Oh, that's great. Excellent explanation. So, Ryan, the second part of that question is, what are some of the considerations today's marketplace, but what's available for accredited and non-accredited investors? So, what Surf gave was just an excellent overview, understanding. So one of the things that we see in passive investment is a lot has to do with the accredited investor, right? So just give us an overview of what that looks like, and then give us an overview or a little bit more understanding of what a non-accredited investor can have, or at least get access to.
Right. So, we have our normal Reg D investments that most real estate shops offer. We have syndications, we have existing properties where you're buying in an equity into an existing property where there's already rent rolls coming in. And something we decided to go with was our Reg A offering, which opens up to all investors. And that gives you a little bit of taste of, what debt is and how we finance deals, and you get to take part in that along with us.
That's great. And so are we to assume within, at least in the world of Veloce Capital, can the non-accredited investor also, be a participant of what the accredited investor has as far as a portfolio, or is there any differences?
There's not much differences. I mean, that's the best part about this Reg A offering. We went through SEC compliance review, we went through FINRA, and we made sure that we are in line with everything that we offer with non-accredited and accredited investors.
Awesome. Great. Okay. All right, good. So we're going to move right on to topic number 2. So topic number 2 is, okay, so we got an overview, right? So what's Veloce Capital's position and the niche of the way that we deliver more ways to invest? And this is like trying to get more of an understanding of some of the structures that we have. And then we'll look at, what are some of the performance metrics that are in there, and then, understanding what return on investment means to the investor that works in these structures. So starts off again with, give us an understanding of what are the delivering more ways to invest portfolio from Veloce Capital.
So I'm going to take you back, a few years, right? When we started Veloce Capital and started, working with investors a number of years ago, there was really one option that we were offering investors. As we've grown, we've seen different needs of the investor and what they need in terms of, some people are not accredited, as we just went over. Some people don't want a monthly fixed payment for various reasons. Some guys, want to see the success of the company and they want to be part of the company. Other folks want to own an asset. So as we've grown consistently, we're putting on different products for investors as they're speaking to us. So today we have, 4 different funds that we're running, right? And each one of those has a different directive in terms of how the investor is getting paid, what type of structure we have with them, whether they're owners of the property or not, whether they're owners of a JV agreement or a note of some sort in that asset, or whether they're completely just passive and they don't want to know necessarily on the success of the company. They just want a fixed payment coming to them, right? So Ryan's going to go into each one of these structures for us. But, an overview is that we tag delivering better ways and more ways to invest, because that's what we're constantly doing, right? We're constantly adding on, this might work for this investor. Let's put out another product, right? Let's put out the Reg A, for example, or let's put out a product that we just recently did where we had investors invest up to a certain percentage of an income generating asset where investors might not be making a huge return on a monthly basis, but it's an appreciation play. So it's different wants that investors have had and that they've come back to us with. And we've been able to structure these transactions in these ways. And a large part of that is, quite frankly, due to the vast pipeline of deals we have. So because we have such a vast pipeline and different ways of adding value through either entitlements or higher rents or whatever it might be, we're able to structure these deals in very non-traditional ways and intricate structures that we've been able to do. So Ryan, if maybe you want to go through each fund, I think this would be a good opportunity.
Okay. And I mean, we do have 4 options right now. We have a Reg D equity fund where you take part in profit, and, we gather the money and then we disperse it over, a certain amount of projects to diversify your risk. And you're taking exact part in each one of those deals. And at this point, we have a 70-30 split. So you get 70% of the profit, and then Veloce Capital keeps 30%. And that's the one structure. We do have standalone syndication deals. We usually do ground up, but we also have existing equity deals where you're buying into a property that already has rent rolls coming in. Those can be, split up in many different ways. I mean, it could be, basically an 80-20 split, a 70-30 split, but it really depends on how the deals are structured. The ground up, of course, I think is a little more risky, but you get more on your return. And when you get into existing deals, you have that steady return and you get the rent rolls, and you also have depreciation, which could also give you some tax advantages for people who are a little more, real estate savvy per se. We have a Reg D debt fund where we do offer coupon payments on a monthly, quarterly, or annual basis. This is kind of run akin to the Reg A fund, but what you're getting, what your returns are going to be. And we make the notes up to a 1 to 2 year term. And that's how you'll get your cash flow on that basis, where with the Reg A, it is a 2-year term and you're investing alongside, but you're also taking advantage of the profit that we are making. And I think Surf alluded to that, earlier in the conversation, where, we pool the money together and we put together, say, 10 to 15 deals based on the amount of money we raise. And we split the profit with you guys at an 80-20 split. There's also a 2% management fee on there that helps take care of, the daily running of these funds. Right now we're offering, there's monthly statements that go out. The fund is audited, and we have we have reporting to the SEC, so there's a lot more into that. And it wasn't exactly cost effective for Veloce Capital to create it and run it, but we wanted to make sure that everyone has the opportunity to invest alongside of accredited investors.
Well, that's great, and that provides a wonderful cross section of different investment opportunities from Veloce Capital. So one of the things that usually arises from the investor point of view is, there's a ton of information out there, right? And so how do I make this decision? What are some of the things that are determinants that I see as I would start to look at the different cross sections of opportunity here from an investor perspective? So what are we hearing here from those people that invest with Veloce Capital? What are their decision points?
Right. So a lot of times when we're dealing with investors and they're looking to invest in any type of investment, we tell them, don't invest all your capital with us. That's not the firm we are, right? The person that's investing with us, one, they should be diversified. They should have assets in stocks and their own real estate, for example, or whatever other vehicle they want to invest in. We're an alternative asset class, right? I think that they should definitely have 20 to 30% of their investment in our industry or our asset class, just to diversify their portfolio. So that's the first thing we tell them, right? The second thing we tell them is start working with us on, the easiest fund that you want, or, a project that you can own where you feel secure that you're investing with the right people, right? Come back in a year, you're going to see us. Every month, you're going to have your payment, within the first couple of days of the month. On the equity side, if you're investing in equity, try us out for a year before you go all in. We're obviously looking for more AUM consistently, but at the same time, we also want to have partners who are with us for the long term, and that we can, we can have them in our family, the Veloce family, for, positively, right? We want to have good vibes. We want to have good people, and we want to be able to scale with them. And that's how we've been able to scale. All of our investors, for the most part, are friends of ours. We know them. We are always engaging with them. And that's the relationship we want to have. So if guys want to start out with Veloce Capital, first thing would obviously be make a relationship with us, get in touch with us. We will try and, make you as comfortable as possible. We'll show you exact full transparency on what type of assets we have invested in, what our returns have been, what's in our pipeline, what type of assets we're investing in today. Right now, there's a lot of uncertainty in the market where investors are asking us the hard questions, right? That what's going on with things like interest rates in the market, what there's an upcoming recession, all the negativity that's out there. And our main focus is to be focused in one asset class right now, which is multifamily. And there's various reasons why we feel that asset class is the right one to be in today. So guys that are looking to start investing or investing with us, have a conversation, talk about the economy. Please ask us the tough questions. Ask us why we're investing in what we're investing in, what we see the future to be, what we, what type of exit strategies do we have lined up. And though past performance, necessarily doesn't, ensure future results, it's a really good gauge for investors to be able to see that this is how we've exited projects, and this is how we're looking to get into new ones and what our exit strategies are. So I think the first step would be obviously have a conversation with us and be comfortable, right? If you're not comfortable, we don't want you to invest with us either. We want you to be comfortable. We want you to have a great feeling, and we want friends as well. We want to have people to come and be part of our family.
Great. Ryan, do you have anything to add?
I mean, the good news is, we're right on Main Street in Hackensack. We're, always inviting people in and to get that comfort. And I think that's the big part. And the fact is, myself, Surf, and the sales team are always available to ask questions.
Awesome. Great. So the last part is this understanding of metrics, right? There's all these metrics out there, right? There's IRR, there's ROI, all that. What are the things that Veloce Capital shares with investors in order to show performance, and what does that look like? How do you best describe that? Ryan, why don't you take this on?
This is a great question. And of course, with our offerings, we can't always be very explicit with our returns. I mean, with our Reg A, yes, we are, all of our information is fully vetted. So, and since it's a public offering, we're able to say, hey, inception to date through Q1 of this year, which is a full year, we're up 12.7%. This past quarter, I believe we hit 3.58, and that's net of all fees. That means that's the return that you guys are getting. When it comes down to the other deals that we do, everything is based on projections, syndications or projections. And then we have, the debt fund. The debt fund is pretty straightforward. The fact is, your return. When you're looking at these other funds, we make sure that we underestimate the returns to some extent, that we know we're not being, I don't know the best way to put it.
Under promise and over deliver, right? Is that what you're trying to say?
And we're not growing rent rates at 10% a year because 1 year it went up 10%. We make sure that we're projecting out a safe return. We want to make sure you guys are comfortable. Just about all this data is presented to you guys in our pitch decks. So you guys are able to kind of see where we come from. And the best part is, like Surf said before, we're always available to answer those hard questions. And, sometimes the numbers, seem not to make sense. And that's why you have to reach out to us. I mean, if we send you a sell sheet and you think it's too good to be true, that's what we're here for. We're here to help you understand what we're saying. We want to make sure that you're knowledgeable of what you're investing in, more than just say, hey, give us this money and we'll give you this, these returns.
Awesome. Great. All right. So that brings us to our last topic. And this is, again, goes on a line. I think we touched on it about some of the hard questions, right? So there's a lot of news out these days about, projections and current market status of where we are. How is the multifamily passive investment world today, first quarter 2023? Surf, do you have any reflections on that?
Yeah. So, real estate is very local, right? So that's something I think everyone needs to understand first. A lot of times, I speak with a lot of institutional investors, a lot of high net worth investors, and speak to market makers in our local areas where we invest in. And we get different, data, right? So there's a lot of data that's out there. Now, what's relevant is I think one of the questions we need to ask according to, local data. If you look at national averages for housing, or, everyone's like, what's going on? Houses are at all-time highs. We're not investing in houses, right? So we need to make that, we don't touch single family. Then a lot of people bring data about, office space or hospitality or other, sectors in the real estate space. We don't touch those sectors. So the only thing that we focus on is multifamily. And the reason we do that is for various reasons. So if you look at the macros on multifamily, especially in the markets that we invest in, which is tertiary markets, urban cities, close to major metropolises, certain housing, certain population numbers, and employment factors we look at, as well as density. So that's kind of where we're investing. Now, if you look at that submarket, there's not too much national data that I could give you because it's so local, like I said. But what we do look at is rental rates, right? The rent rates on these types of assets have been consistently been increasing year over year, anywhere between 3% and 5%. During the COVID year, we had even a higher increase in rents, right? Right now, any study is going to show that the U.S. is becoming renter nation, right? That it's much harder to purchase a single family home. Interest rates are high, and a lot of people are resorting to renting properties, and that is causing a crisis on the single family home, right? Because of that, there aren't as many people that are being approved as first-time home buyers or have the capital to be able to go and put, six figures down on, their first home. So they resort to renting. Now, what's caused there is a massive shortage of housing for multifamily. So we are focused mainly there. Interest rates are higher than they were, but they were too low during the COVID years, right? That was not sustainable the other way. So we see a little bit of a jump there, but we've seen a much higher jump in the rental rates. So all of our projects that we projected at that time have now exceeded and superseded what we were expecting, right? And everything we price in today, we look at what's the debt service coverage ratio going to be? Is there enough capital? Can we safely say that we're going to get, 70% of our capital out of this project to create, the IRR that we've said we would, right? And yes, the answer is yes. And we are exiting deals on a daily basis and deploying capital on a daily basis. So anything in multifamily, the beauty of it has to do with the rent that's coming in. Everything's appraised, everything's valued based off the cash flow that's coming into the asset. Now, if we have that key number, what is that rent that's coming in? We can calculate the rest of the project and see the viability of it, right? So it's not that we have a magic formula or anything like that. It's just, there's X amount of units. This is the rent that's coming in. These are the expenses of the asset that is going to be. This is what the value would be based off that, and based off the debt service coverage ratio of, a 70% or a 65% or a 75% LTV, depending on where interest rates are. Can we exit this project or not? And if so, what would the return be to Veloce Capital and then to its investors? So that's kind of the macros of where the market's at. So I think a lot of times when people read the news or see what's going on, it's very broad, and they have to be able to understand it in their market, right? So if in our market, in our current, area we're investing in, we looked at office space, for example. Yeah, that would be a valid concern that, hey, this isn't the right asset here. We're, not going to get the rent, or we're not going to be able to fill it up. We're looking at places where there's shortage of housing. We're looking at studies that are putting things out to 2030, even with everything that's approved and being built by everyone in the market that we're working in. There's still a housing shortage, right? And that's not going away. The other thing we're also looking at, which helps a lot in urban areas, is what's the FMR? What's the fair market rent if we had to look for non-market paying tenants and go to HUD type tenants, right? And who are on affordable housing. Do our projects still pass that stress test? And the answer is yes, right? The other thing is, when you're investing in real estate, you're not investing in things like stocks or anything that are, where you could get completely wiped out. That money that's being put in is being put into an asset that's going to be there, that will create generational wealth, that will always over, a time horizon increase in value, right? So if we had 1 year, which I don't foresee happening, but that was lower than expected, the next year, that asset is just going to keep going up in value, and there'll always be appreciation, right? And that's if there was some sort of catastrophic event or anything and something completely out of left field happened, right? But for the most part, I feel that multifamily real estate investing today is the safest investment there is, due to all the unknown variables in investing your capital in other types of investment vehicles.
Excellent. And Ryan, if you would just finish this off real quickly. So it sounds like there's a lot of options, right? There's certainly a tremendous amount of consideration based on how Veloce Capital, does due diligence in order to get into investment structures and how to maintain them and make them worthy. Could you give us, from an investor's perspective, what is the process of starting this, and then how do you become sort of this client engagement within Veloce Capital's investment structure?
So I think the big thing is underwriting. That's what we do on just about all of our deals, and I think that's kind of the way you can understand where we come from. Our goal is to make you guys partners with us and our goal is to show you how we break down those numbers, and that's how they get involved. You reach out to the sales team, you reach out to us, and we walk you through the process. And as these deals pop up, we hand out sell sheets, and you guys will be able to see, kind of what our take is on each individual deal. And that's kind of how we grow our investor base that way.
Awesome. Well, that brings us to 4:30 local time. Thank you everybody for attending. Thank you panelists, Surf Dinani, CEO of Veloce Capital, Vice President of Compliance, Ryan Yates, and everybody who attends, and those people who are going to be watching us soon. So I'm Jeff Smith. Thank you very much. And we're going to do this on a monthly basis. Please look out for the notifications that are going to be sending out through email. We're going to be looking at the different offering structures rather than being general, but we want to give you this baseline information about the company and the way we work in order to get you more comfortable with who Veloce is and how we bring and deliver more ways to invest. Thanks, everybody, and have a good day.
Thank you.
Thank you.